Factor investing is leaning or tilting, we describe a portfolio towards certain characteristics that have been identified through academic research as giving you a chance of a higher expected future return. Hundreds of factors have been identified, but there are certain key factors which have shown to be persistent across time. And these are the main characteristics which we would try to put into a portfolio. Those would be size, value, momentum, and profitability. So with a portfolio, an index portfolio, you'd start with the markets and you would then lean that market towards certain things. So size would be that you lean away from the very biggest companies in the stock market. So if you looked at the S&P 500 or the FTSE 100, most of the value of those indexes is in the top 5 to 10 companies, which puts a lot of concentration risk into your portfolio. So what we actually do is tilt it towards the companies at the other end of the index, which are small companies. And those companies have historically given us a higher rate of return than the very large companies. And that can change over short periods of time. But for a long-term investor, a tilt towards small will give you higher future expected rates of return. Value stocks are the opposite really of a growth stock. So a growth stock you could characterize in recent years of one of the Magnificent Seven. So maybe Amazon or Alphabet, company that's grown a lot in recent years. So the cost of them is high. A value company would be the opposite. So they're undervalued at this moment in time. So it would tilt you slightly away from these very, very large growth companies. You would still own them, but you tilt away from them. And again, this is a way of diversifying your portfolio and not having a concentration risk on the companies that have done very well recently are less likely to do very, very well into the future or to continue and be persistent in that growth. That exponential growth at some point stops and is replaced by something else in an index. And those companies have yet to be identified because it hasn't happened yet. Credit and duration. So how long is a debt going to last for? Fixed income is debt. You're lending your money to a government or an institution. For how long? That's duration. So short duration has been identified as giving you higher rates of return because there's less inherent risk of lending money for 5 years as opposed to 20 years. We don't know, or you're less likely to know the future financial stability of a company or a government so far into the future. The other factor with fixed income is creditworthiness. So are you lending your money to Apple or are you lending your money to Argentina? Now, if you're lending it to Argentina, you're expecting a higher rate of interest on that debt because it's less stable. There's more likely to be a default. There has been in the past. If you're lending the money to an Apple, a corporate, or a US, UK government, and certainly in the case with the UK, US government, a default has never happened. So you will get a low rate of interest, but ultimately you're highly likely to get your capital back at the end, and that increases, again, your expected rates of return. If you're investing for at least 10 years plus, then factor investing is worth it. Historically, 80% of the time, you are getting a high rate of return than the market on its own in rolling 10-year periods. So if you're retiring today, your time horizon is likely to be until death or second death. That could be 25, 30 years, maybe longer. Is it worth it on those timescales? Absolutely.